Welcome to today's Altimetry Authority. Join us as we hit a bunch of great topics.
DC is causing a market meltdown. What should you do, and should you be panicked about the market pulling back more, or should you be thinking about buying the dip?
The Fed is going to kick off an M&A mania from, I think, some healthier regulatory, and we're going to see who's being appointed and whether that makes sense.
Can Eli Lilly really double its asset base, and should investors be excited or concerned about that?
An $81 trillion mistake at Citi is one reason they may not be benefiting from the lower banking regulations we're seeing. What's in store for Citi's future, and is it a stock you should be looking at?
And Qualcomm's got a patent cliff-like drop looming from Apple. Should you be excited or concerned about what that means for the stock going forward? So the market's been in a free fall, it feels like, for the last month and change. And if you really look at it, right, a lot of this market sell-off that people want to talk about is really a good chunk of it's emanating from DC as opposed to emanating from the market itself. Well, there's been some noise. A lot of the bigger reaction has been, you can trace it back almost to, if you will, the State of the Union, where you got a president who's talking about things like focusing on balancing the budget, who's talking about education reform, right, highlighting crime stats improvements, right, discussing potential entitlement changes and adjustments, and of course, right, announcing big forest policy initiatives. And
now,
obviously,
Rob, I remember this. I just want to let you know I do remember this this address to Congress.
I'm sure, right? And if you know, of course, everybody, we're talking about Bill Clinton's address to Congress, his State of the Union in 1997, where literally, if you go, we go back, right? None of these things literally sound like they could have been pulled from the Trump joint session for Congress, right? Obviously, not a State of the Union for Trump, right? Talking literally about, hey, we've got to balance the budget, and right, Joel Clinton went through and actually went through the process of furloughing and offering buyouts to government workers, just like Trump did, right?
Oh, the similarities in things, army bases, right, that got closed down.
Yeah, I remember upstate New York.
If you recall, this is his second term. 97 was the beginning of his second term, which means he wasn't worried about re-election, and he went very center on a lot of topics that were not, at the time, the Democratic Party wasn't happy with. Does that sound similar? Meaning the amount of similarities between that State of the Union and that the market fell. I think that's the point you're saying.
Yeah.
The market fell after this because people are worried about this uncertainty and too much change, and GDP might fall if we start reducing these programs and not spending as much by the government, whatever. Awfully similar. And as you say, Rob, it just, what a wonderful 97 to 2025.
And for context, everybody, when we say entitlement changes, it wasn't that Clinton was expanding entitlements and Trump's talking about shrinking them. Literally, Clinton was talking about turning welfare into workfare. And so all these things were very, very similar conversations. Now let's talk about some other headlines, right? We've got legislators talking about taxing, changing in tax code. We've got the State of the Union. We've got discussions about, loans for small businesses, what's going on there. And then the final one, which is important, is treasuries rising as investors await Greenspan's testimony. Those headlines, if I hadn't said Greenspan, right, also sound just like they do right now. And so, for context, the reason why we're focusing on this is if you look and you go back to 1997. And you actually rewind the clock even from 1997. So, a really important thing that happened about 2.5-3 years beforehand, and that was in late 1994, Netscape Navigator is launched. And Netscape Navigator is important, right, Joel, because of the fact that we're talking about right here the first tool that really let anybody understand that they could actually do stuff with the internet, and the internet could be productized, right?
That everyday people could use a web browser. I mean, Netscape, I don't know if you remember, 86 to 90% of the entire market, like everyone who is accessing the World Wide Web, right, the internet, was using Netscape to do it, and they said suddenly, oh, look at this world of information. This is going to change the landscape. There's going to be this whole internet industry, right? Very similar to the way people are talking about AI over the last year and a half or two.
Yep, and so what happened was Netscape Navigator launches. It subtly begins this bull market in the NASDAQ. The NASDAQ rallies up over 90%, almost 90%, in the span of basically the 2 years and change into January 1997. And then in January 1997, the first big thing that happens is all of that noise coming out of Washington hits the tapes. Everybody gets a little nervous. And also just the natural concern that everybody has of, wow, this has been a 90% run in 2.5 years in the NASDAQ. That's really hot. Starts to sell off in the market. Next 3 months, yeah.
And just think of this. So there's a run up, there's an over exuberance into the Bill Clinton's second election,
Yeah.
right? And then he brings that State of the Union, and people start worrying about, there's going to be government cuts and government spending. GDP is going to be reduced because the government's not going to do this. And he did do a lot of that, closing bases or whatever else. And so there was some, right, people think it, but there was a big sell-off. There was a correction, right, at that time.
Yep. Yeah, I mean, market pulls back around 13, 15% over a 3-month period. And holy cow, if not only the headlines, the market charts look the exact same today versus back then. If we basically do the exact same, right, it's creepy. It's if for those of you who are Office fans, it's like with when Pam gets shown 2 pictures and she goes, it's the same thing, right? It's literally the same thing here. So if you look from November 2022, when OpenAI launched ChatGPT, to today, almost exact same market, short-term market top, and then also 13+% market pullback in the NASDAQ since then. And right, why is this important? Because of the fact that these natural things happen. And look, I mean, obviously, Joel, right, the government wasn't the only issue pulling this. There's been other ones too that have been causing this consternation now that often sound a lot like 1997 and people worried about the internet, right?
I think the main catalyst really for the sell-off was the tech sell-off, obviously, as that's the biggest part of the S&P. And it was because of DeepSeek. And people suddenly said, DeepSeek's here. And supposedly it was super cheap. Right? Supposedly, DeepSeek was performing better on so many ways, and there were ways that it's performing better. But that was what led to the sell-off. And suddenly people thought, AI is not all that, and these AI companies are going to be able to make money or whatever. But I think we found out and realized that the reason for the catalyst being DeepSeek no longer is the threat that people thought. And the threat is off, but the market hasn't recovered yet because there has been some profit taking. So one, DeepSeek, right, the Chinese version of a ChatGPT or a Grok or a Perplexity, one has a hallucination level, meaning giving you fabricated responses that it just thinks of out of nowhere at a level that's 5, 6, 7 times higher than the major ChatGPT or Grok 3 or whatever else. I mean, you're talking about like 1 out of 7 or 1 out of 6 statements that,
which is
meaning
wild,
14 to 15% hallucination rate. So I don't know how anyone could ever depend on DeepSeek with that kind of performance. I mean, it's fast and it's a little cheaper, but the quality is terrible. I don't think the world is going to suddenly stop using the XAI, Grok 3, ChatGPT, Perplexity world, which are all based in the U.S. The second thing is they said it was super, super cheap, and it only cost $6 million to build. Yeah, but it was riding on the backbone of a hedge fund building a mainframe that had a ton of NVIDIA chips, some of which were brought in and bought before the sanctions, and some questionably were purchased through other means, like through Singapore, post-sanctions. We're still waiting to find out. But no matter what, everyone agrees there's a massive amount of chips being used there. So it wasn't this sell-off that just said, oh no, AI is overspending and it's not useful and whatever else. And that's what really led to this. So when people remember that the catalyst for all this happening is no longer the catalyst, it just doesn't exist. It wasn't that US AI is dead and China AI was going to take over and be in the lead. That is not possible. It is not. It is a pipe dream to even say so. It is. I mean, there's a lot of propaganda pushing it, but still. The second thing, and so Rob, on the AI thing, I think AI is still here to stay. The world, just like the internet industry, it's not the internet that benefited from the internet industry. It's every company, every consumer, every human benefited from the internet changing and making things more productive. And we will see that with AI at levels, I think, that the internet doesn't even come close to. Massive productivity changes, improvements, and you name it, and not just in the AI group of companies, but every company, the S&P, will benefit from AI. And if they don't, then they'll no longer be S&P, meaning you can't survive without AI in the new world. And we think this is even bigger.
Yeah, just like what happened with the internet, where basically every single company had to adapt. And I mean, the other important thing is if you look, right, as we get into this pullback and everybody's worried about, oh no, the recession words getting thrown around and everything else because of government cuts, not actually because of any of the AI stuff, but people are worried about the government. You look at any credit signals, everybody, and we look at a lot of them. We live in the world of credit every single day. We look at CDS spreads, we look at debt maturity head walls for corporates, we look at availability of credit, all these things. None of those things are flashing reasons to say that we're about to roll into a recession and that credit destruction is about to happen. In fact, it's quite the opposite. And so why is that? So go, Joe. Go, Joe.
Just for your analogy that you brought up, much like in 97, one of the reasons that the market was able to rebound so quickly is because there wasn't a corporate credit crisis. And every prolonged bear market in the last 200 years in the United States has been preceded by our corporate credit crisis. And in this situation, we're going into credit that's getting healthier every day, the opposite, and a much more robust credit market than we had in 97 or in 1920s, or if we can go back, honestly, we go back to even the 1800s and look at the markets. And so what we're seeing is the setup for, now we're not saying back up the truck right now, but one, if you didn't sell into this sell-off, this recent sell-off, if you did not sell your stocks, it's too late. Don't sell them now, right? If you didn't get that trade in, don't sell them now. And if you've got dry powder to put into equities, now's the time to really start legging in. Because the corporate credit
buying leadership. Right, because again, if you had done that, if in 1997 you had panicked with those headlines and sold out, you would have been up around 70 to 90%, but you wouldn't have been up 600%, which is where the market finished. So, related to the idea though, Joel, you touched on credit creation, right, in terms of how healthy of a credit creation environment that we are, and there's news out there.
America does not run on Duncan, it runs on credit. America runs on credit.
That's exactly right. America runs on credit, and we're about to actually get more signals from the Fed that we're going to make it easier for America to run on credit. Because when everybody wants to focus on, Trump's tariffs and, basically government spending, many are not paying attention to the idea that the other part of what he wants to do is deregulation. And part of the deregulation mantra comes from, right, Michelle Bowman actually talking about her eventually stepping in, right, Joel, as the vice chair of bank regulation, I want to say, at the Fed.
Yeah, well, she's the head of bank regulation, is the vice chair of the bank supervisory group of the Fed, if I'm correct. Right, but either way, she's going to be the head bank regulator, and I think people should see this as a massive positive. I mean, for a lot of reasons. One, she checked a lot of boxes for the Trump administration. First off, meaning she's actually worked. This is interesting for a Fed governor who's actually worked in the financial area and seen what's happened in FEMA. She actually worked in the financial section, as a financial advisor in Homeland Security, right? And then when it comes to, again, for a Fed governor who speaking at fintech conferences, speaking at blockchain conferences, I'm talking about the last 9 months, right? Let alone over time, and has been dubbed by others as one of the, what's the term? Regulators getting to yes, meaning responsible regulation. And she really has said that there's too stringent regulations on banks, and they should be pulled back and done right for the type of bank that you're looking at.
Well, and Joel, and also, and she's a lifer, right, in the banking industry.
Well, Bowman is fifth generation of community banks. And she understands that you can't apply the same regulations to Citigroup as you'd apply to a community bank. Because if you do, the community bank just is done. And yet at the same time, to know what some particular farmer needs for credit and financing needs, to know what some particular industry in New Jersey or some particular real estate businesses or office real estate business in some other part of the country can only be done by some of the smaller banks, right? It's a reason why there are 8,000 banks, banks including credit unions, 8,000 plus in the United States, because you really need to localize that. And I think she understands that at a really deep level, and that is wonderful for, I'll say, correct regulation, and in most cases, I'd see some deregulation that would allow banks and free up more credit for American businesses and people.
Right, because for everybody, for context, right, when we look at this, the banking industry has been in kind of a challenging situation for the past 3 or 4 years, because what happened was we had this wave of cash flow to the banks in 2020 and 2021 as everybody got basically money in their pockets. Nobody was spending money. Companies were flush with money that they weren't able to spend because everything was shut down for COVID. Banks got all this money and they put it to use buying either writing mortgages, buying treasuries or whatever else at really, really low interest rates. And then when interest rates jacked up, all of a sudden they were in a situation where they couldn't make money anymore. And so we went for this environment where we went from, in 2022, 30 zombie banks. And for context, what zombie banks are banks that basically aren't working, right? They're not actually making loans. They're just kind of surviving off their existing loan book. But PNC, right? Well-respected bank and research shop, put out in 2022 that they were seeing basically 30 zombie banks. Well, another research shop, FIC, in late 2024 came out and said they were estimating 265 zombie banks were out there. So when we actually look at it from Altimetry's perspective, we did our own research on our own zombie bank report, and we looked at all the banks that are greater than $50 million market cap, meaning, right, when you talk about 265, that includes a lot of those small banks that Joel was talking about, and in New Jersey or in a Sioux Falls, South Dakota. But we just basically said, let's look at the big banks, the banks that are big enough that they're investable. We found of the 300 or so, right now, 65 are what we'd call zombies. So that's 20% of banks, up from 12 in 2022. So Joel, that's a pretty steep jump that really calls for some changes in bank regulation, right?
It does, and then you have to say, is this a crisis in terms of, we're not talking about the 10 biggest banks in the U.S. We're not even talking about of the 300. Most of these, I'd say, Rob, are on the bottom half of the size of the bank, which means this isn't a banking crisis, these zombie banks. It's an unbelievable opportunity. It's an unbelievable opportunity.
Exactly. And so when you look at it, we've seen bank consolidation. When you just think about FDIC insured banks, so not the credit unions and everything else, which gets you that 8,000 that Joel said, that you said, we had about 4,000. And if you talk to anybody in a regulatory world, what they'll tell you is probably we need 1.5 to 2,000 banks, not 4 or 8. What's a good thing is, and this comes the idea of, even though we've got these zombie banks that need to be digested, we've got banks that overall have, when we look at it from a uniform accounting basis, really, really healthy ROEs right now. So, right, we've got uniform return on equity, which is when we clean up all the data and we look at what real profitability is for banks. The average bank in the US right now, publicly listed bank, has about a 17% ROE. That's like 2 times what their required rate of return is, what they need to basically justify their existence. And that means we've got a lot of banks that can definitely absorb some of these zombie banks. And if Bowman gets in and starts to let consolidation happen, that's a really good thing, Joel, right, is the point that we're making here.
Yes, I think it leads to an opportunity because, I mean, some of these little banks, they're decent, but they're just overexposed. They're so small that when their client base is only one type of client, like office real estate, and office real estate's bad, they don't have anything to offset it, right? And yet there are good loans there, whatever else. It's just that these banks can't survive on their own. If we see some consolidation, the larger bank can, one, make sure that the smaller bank doesn't actually go under, or the FDIC doesn't have to take it over like they had to do with Silicon Valley Bank or whatever. They're small enough. And that's why I said this isn't a banking crisis. This is an opportunity, because of these 20% of the 300 or so banks we looked at, the bigger 300 banks could easily absorb these 65 and actually make them viable again, and make sure the depositors are still, those deposits are, Rob, you say unlocked is the term used. The loan balances are still good. They can work with their client base. They can still grow their business in a way that those smaller banks just can't do on their own. So the consolidation that we expect to see does mean that the bigger banks that eat them up are going to get some bargain basement pricing of these zombies. And because of that, there's a bunch of banks that we actually have been looking at, from a stock market, stock picking standpoint, let alone what's happening in the industry, which we think is going to be very healthy. And the Michelle Bowman pick is very positive for all this.
Yep, exactly. So let's talk earnings uncensored, and let's talk Eli Lilly. Eli Lilly obviously has been all over the news because of the world of GLP-1s, and Joel, we know your strong opinion on GLP-1s.
I did get a lot of. We did get a lot of feedback from our subscriber base on the comment. The comment I made was if GLP-1s are going to do well because they can do much easier what good diet and exercise somehow would do better, but people don't do it. I have, and someone gave me a lot of heartache about that, a few, and I agree. There is. I wanted to look at it deeper. There is some people do genetically have a food drive, which because of their youth or because of genetics or maybe a combination of nature and nurture, that they just have a really strong food drive, and a drug that can help them get out of that. Ultimately, if it helps them reduce obesity, if it helps them feel better about themselves, and then maybe if because of it they actually do, because they're eating less, they eat better, and they, start actually doing more exercise, it might actually be a little more positive. I think I knocked it too much, but regardless, There is something to these GLP-1s.
Yeah.
There is something to the Ozempics.
Well,
and whatever.
but also to your point, I think that even Eli Lilly's research would show taking GLP-1s on its own, or Novo Nordisk also, right, their competitor in this, is not the answer. It can help for those who feel like they're so deep that they can't even start to fix it. But you still need to eat healthy and exercise, right? And those two things are very important. It's not right. Skinny fat is still a real thing. But so, anyways, that aside,
What Rob is saying is that a heavier person who exercises 6 times a week is much healthier than a thin person who doesn't exercise. The research has come out so big on that.
Cardiovascularly,
Even if
everything
your
else.
BMI or other things that your weight, given your height, may be a little bit on the heavy side, as long as you're exercising a lot and you're eating well, you just happen to be a bit bigger, right? That's okay. So anyway, at least I hope so.
But because of people who are interested in what GLP-1s can do from a weight loss along with everything else, the demand for GLP-1s for these weight loss drugs is unconstrained. So it's not surprising that Eli has come out and said, hey, we're going to spend $27 billion in new U.S. plants. And just for perspective on that, everybody, Eli Lilly's total assets right now, their total property, plant, equipment, factories, and everything else they have is $28 billion. So what Eli Lilly is talking about here is doubling, right? Doubling its asset base in a real tangible way over the next couple of years. So Joel, you want to walk people through why maybe the market doesn't realize how this is so interesting?
So first off, straight out of the altimeter, right? We do not rely on GAAP accounting. Nobody should. Nobody worth their salt. Not Buffett, not Klarman, not Munger, right? Not Ben Graham, going back 70 years, would ever rely on GAAP accounting. There's the nonsense, meaning generally accepted accounting principles and the way it's talked. And this is just an example. So the orange is the actual GAAP as reported EPS under generally accepted accounting principles. And for Eli Lilly, it says, how can the stock be up so much in the last several years, right, into 23's full fiscal year? How can it be up so much when, look at that orange, when the EPS is actually slightly down? And what they don't realize is GAAP accounting grossly punishes and makes a company that's investing in R&D, makes a company that's investing in its distribution centers, investing in property, plant, equipment. They completely violate the matching principle, right? And they make these costs front-ended. And so when a company is at early stages of a big growth cycle, it will make innovative companies look worse. And that's what you see. The EPS number is actually even down from 2022. And you're like, well, what's going on? Now, when you switch to uniform accounting, you actually see, one, that the blue, the uniform accounting EPS, is not only rising, but it's rising to levels that are double or triple what the as-reporting earnings number is. And then when you add Wall Street estimates, and this is the one thing where Wall Street stock recommendations are terrible, right? Wall Street target prices are ridiculous. But when you get into the deep industry information and they build up pro forma numbers for unit sales, case sales, drug sales, whatever else, honestly, the Wall Street analysts are pretty good. That's the reason why they still have a job, despite how horrible their stock picks are, is because their industry analysis is great. So we take that analysis, right? We put that into uniform accounting. We convert it and we say, if the Wall Street analysts' pro forma numbers were converted to uniform accounting, they are basically saying that this company's earnings will double and a half again going out into 2025 fiscal year. And finally, right, what does the market think? The market seems to say, we'll accept that and we'll give you a slightly higher earnings number over the next few years. So this actually means if you believe the Wall Street analysts' deep analysis, not the recommendations, but they're actually deep industry analytics on what's going to happen with Eli Lilly's drugs and what they're selling, you'd say, well, I only need a slightly higher return than that to justify their current price, which makes them kind of interesting to look at as a stock. Meaning, it could be that their forecasts are a little bit on the low side.
Especially if this company is going to be doubling its production capacity, and all that 2025 earnings growth is not showing that yet. That 2025 forecasted earnings growth is before that doubling. They've got plenty of room. And Joel, right? I mean, we look at the earnings call analysis that we do, on these things, and we see a lot of confidence in management that shows they really believe that this is going to come through.
Yeah, we run an earnings call forensics. We listen to the calls. We listen with a technology called an electroaudiogram. What we've built is proprietary. Honestly, it's pretty amazing. And it literally flags not just dissonance or cognitive, I'll say, deception or deception of themselves, but it also shows when they're genuinely excited. And you see authentic enthusiasm from Manjaro and Zepbound, meaning management truly believes that they're going to see this work, and Wall Street agrees with them. That's why you see such big forecasts for
rising earnings growth,
fiscal year in 25, rising earnings growth, rising return on assets. You do see, I'll say, some flags on supply chain when you listen to the forensics, but that's because they're about to double, right?
Exactly. They need to fix it.
Right? Yeah. So it's not that they're deceptive. I'd say it's probably more that there's some dissonance because they've got to fix the supply chain issue. They cannot fund the demand yet, and they're going to have to build like crazy. And when you're going to double a company of that size, of course they're nervous. So we do pick up that nervousness. I think that's normal. The one thing I'd say is when you listen to the calls, and it's not a bad thing or a good thing, it's just that there is such importance on orforglipron. And orforglipron, if you look at that, this is their oral base, because there's so many people still don't like shots. They just don't, they're not comfortable. Then they have an oral-based version. We'd call it an oral GLP-1, but technically it's not a peptide, so GLP doesn't fit. It's just an oral version of Manjaro and Zepbound. And a lot of that is built in, and the company's kind of banking on it. So right now, this is zero of their sales, right? They don't have it yet. But if they have it,
it's a growth opportunity. Yeah,
and
exactly. And that just further stacks on this to everybody to get to the point of, look, expectations are actually not out of line, especially for a company that's going to potentially double. Now, obviously, Eli Lilly is a company with great news coming its way. And we were just talking about, from the bank's perspective, how banks are potentially set up for everything wonderful as the new Fed perspective is probably later touch regulation. But I think, Joel, there's probably one bank that the Federal Reserve probably feels like needs a little more severe regulatory touch, not less. Would you say that's fair about Citigroup?
The likely Trump appointee, Michelle Bowman, is known to be a friend from a regulation standpoint, but she says responsible regulation. Right. I think for responsible regulation, Citi is the one where you're going to see more regulation. They don't have more regs on them versus less, given some crazy mess ups that they've had. This is one of them, but there's so many of these.
Let me just take everybody through this. So Citigroup earlier this year literally tried to transfer 81 trillion with a T trillion dollars into one of their clients' accounts. And yes, you're thinking about that right. That's 2.5x US GDP. That's 40x what Citi's total balance sheet is. And this isn't the only time that Citi just totally had a fat finger disaster about transferring money to people. Just shortly after this, they had another $6 billion they almost credited to a wealth management client who definitely did not have $6 billion in their account. And this goes all the way back. For those of you who followed this for a while, Citigroup got in, basically was an embarrassing headline for years after 2020 when they, get this, Revlon had a $900 million bond that was due in 2023. And in 2020, Citi just sent a payment to everybody to basically repay it in whole and never got half of it back. So this is a bank that really does struggle to function as a bank.
I came from the consulting world. It is a management consultant's dream because they seem to not be able to fix anything themselves, and they seem to be willing to spend unfathomable amounts of money on consultants to try to fix them, to the point that at some points you start wondering, who's running the bank? Is it the bank, or is it a whole bunch of vendors and consultants that have filled in spots that have just been stuck there for 20 years? I'm not kidding. Right? Consulting groups that just had ongoing projects for 20 years. So are they consultants? Are they actually operating the business because nobody internally can?
You know how we joke about how, Pfizer, everybody, to go back to talking about healthcare companies, Pfizer has $1 to $3 billion in special items every single year. So we always joke this idea that Pfizer, meaning non-recurring charges that are recurring. And so we joke about this idea of they have no idea what their actual earnings is. I wonder, Joel, if the consultants who point, many careers have been made on consulting Citigroup. I wonder how much they do just enough to make sure they're going to get that next contract. And that's why Citigroup never fixes anything.
But not enough to actually fix the business, but just enough to fix enough. And then, I guess that's your goal as a consultant, is you want to make the banks depend on you. And there's I'm just telling you, there's a lot of consultants. I'm not picking on any one firm. A lot of firms that make a lot of money off of Citigroup's trying to fix itself, or fixing errors, or go all the way back to Y2K if you want.
Right. And so if you look, Look, I mean, banks as a whole, actually, right now, right, even though there are a handful of zombie banks or anything else that you want to talk about, that people want to talk about for no, banks as a whole are actually very helpful in terms of ROE, right? 17% ROE, like I said, 2 times what they need to make. Citigroup is the exception to that rule. So when we look at ROE for a bank, right, in terms of how profitable that bank return on equity is, for Citigroup, we said 9%, 8.5 to 9 is kind of what you need to make investors feel like there's a reason why you need to exist. Well, if you look over the last 4 years on a uniform return on equity perspective, Citigroup has a sub 9% return on equity, right? So weak performing business because they're having all these issues.
Well,
Yeah.
for 20, so just think of this, just in context. The average of all the public listed banks is a 17% ROE, and Citibank is maybe 6. Citigroup is maybe
Right.
6 right now, 6 versus 17. So we're going to show a stock chart in a second, and then you can see this really come alive. Now, the Wall Street analysts, if you look at the shaded blue bars, if we take Wall Street's understanding of banks, which we respect. We don't respect their stock recommendation.
Yep.
Nobody should. You don't respect Wall Street's target prices. Nobody ever should. No investor worth their salt. But when you look at their detailed information about bank loans and bank credit and bank business, it's pretty good. And we take that information. It says that Citigroup, okay, maybe they'll improve a little bit in the next couple of years from 6 to...
That's a rounding error. They're still saying it's terrible, Joel. Let's not be nice. We don't need to be nice
bad
for any
business
reason at all.
that stays bad, and the stock market's saying and will remain bad, right? It'll
And this is
remain
the thing.
low return versus the average.
Right, and so if you look, Citi has massively underperformed the market since the end of 2019. The S&P 500 financials up 60%, Citi down 12%. This is a bank that if you just look at their inability to just function on the basic things that banks need to do, send money from here to there, probably says this isn't one to think that you could buy the dip on how Citi is so beaten up. And this is probably not one that if we talk about the Fed getting later touch on regulation, that they're going to be a beneficiary, because they're going to be probably one of the exceptions that the Fed is going to keep their eye on, right, Joel?
Yes, and I will say it still comes down to incentives dictate behavior. I think people know that one of the things that the most important financial statement for forecasting the future is not the 10K, it's the DEF 14A. The SEC requires Schedule 14A, and Schedule 14A tells you incentive compensation that's built into a company. And so when you have 70, 80, 90% of management's compensation, all the named executive officers, the CEO, are getting paid based on these metrics, you have to say, what metrics are they using? And in Citi's case, they're heavily using earnings per share, not earnings, not the growth of business, but earnings per share and tangible book value per share, TBVPS. Now, why is that concerning? It's because they're using a per share metric. When in doubt, if you can't improve the earnings number to make it look better,
you run your business poorly,
because you're running your business so poorly, obviously, right, then just reduce the share count. And so while they have been spending a lot of money on consultants or whatever else, they have not been spending enough, you'd argue, on fixing their business. But instead, what have they done? In 2023, they did $6 billion of share buybacks, right? In 24, they did another, $8 billion of share buybacks. So let me just say, forget the word buyback, right? They're buying shares of Citigroup, and the stock is falling during that time frame. Meaning, if they just bought $14 billion of the S&P, this bank would be in a lot better position, right? A lot better position than buying back shares of their own stock. However, why do they do it? Because their compensation goes up. And when you look, despite the stock being down, you can still see management making a lot of money based on performance metrics, which are going up. Not EPS is not going up because their earnings is going up. It's EPS is going up because their share count's falling, because they're buying back shares. That is not the right thing for the company. It's not right for the thing for the business. They should not be buying back shares to the tune of $14 billion over the course of 2 years.
2 years.
But man, are the incentives built to pay management to do those things. It's a massive problem in their pay, and it's another reason why I would say don't think that Citigroup at any point in time is going to be a interesting stock idea, because it really is in a tough situation, and we don't see reasons it's going to get out.
Exactly. All right. Now let's talk about a company that the market thinks has really tough issues that's going to get hard for it to get out of, but maybe the market has overblown its concerns. So Qualcomm has been in the news because even though positive trends have been around smartphones, Qualcomm stock has a weight on it, which is a weight that is in the shape of a giant apple. So Apple has been Qualcomm's biggest customer for forever. Right? They have to pay them licenses for being able to use the technology that Qualcomm has. They buy modems from them to make sure that iPhones work correctly and iPads and Apple Watches and everything else. To the tune of, for a company with $41 billion of revenue, Apple is about $10 billion of it was what it was, if memory serves me correctly, in terms of what the number is. So, and Qualcomm has basically said, hey, look, Apple is going to stop buying from us by 2027. By 2027, our Apple revenue is likely to be this, right? A 25% drop in the stock. And so that, and Joel, a couple other things have really actually sent analysts panicking, right?
Well, I think, the issues are, even though people know that, look, if Apple's going to spend $500 billion, which they can't possibly, but if they're going to spend a huge amount of money building plants, they got to make stuff. And what they're saying is, we're going to start making the things that we used to buy from our vendors. So we don't have to buy your Snapdragon super Qualcomm, wireless technology kind of thing. We're going to make it ourselves. So, but everybody knows this, right? Everyone knows this. So the thing is, what's happening is that Qualcomm is still selling more, but people are concerned because the smartphone in general market is kind of saturated, right? Everyone already has 2 or 3 or 4 cell phones, and around the world, even the poorest communities, right? It's interesting. I see this in Southeast Asia all the time. People get paid, right? And they spend it on their telecom, then they buy food. I'm not joking, right? It's like I'm going to pay for my phone so I can stay connected to my friends and family because I got, I'm super, super poor. And then whatever I have left, I'll spend on groceries. That's not an exaggeration. So at that point, you'd say the market's kind of been saturated at this point. And so people are concerned that maybe the smartphone market's saturated.
And I think that, in that context, right, because that's the other noise, Joel. And I think that you got a great story about, somebody who we've listened to say thoughtful things about how Wall Street works, because he is a well-respected Wall Street analyst who's kind of highlighted some of the other concerns out there, right?
So in this space, Tal Liani, who's at Bank of America, who's arguably the true number one analyst covering these stocks and been covering Qualcomm for years. I asked him to come in and speak at one of my MBA programs, live and in person, not virtual. And he actually physically came in. It was wonderful, and he spoke. And of course, the student said at the time, I think he had like a 49% track record of picking stocks, meaning he was dead on 50.
Getting his recommendations were right. Yeah, exactly.
And he was the first to say, listen, nobody pays me to be a stock picker. Being a stock picker is my client's job, meaning all the investors that pay attention to him. He said, my job is to be the world's number one industry analyst about this company. And, I'm required. He even said I'm required by law, by the SEC, that I have to put a target price and I have to put a buy-sell recommendation. I actually added the comment that of all the analysts I've spoken with when he was presenting in my class, I said, I can't tell you how many analysts wish they didn't have to. They just want to be industry analysts and industry experts. So he's great. He focused on an important question. He was on the last earnings call that Qualcomm did, and he was the cleanup. I think he kind of waited until the last question, and it was a doozy. He said, look, the smartphone market is flat, but you guys are still posting growth. And he said, what's the longevity of this? Like, how long can you keep selling more chips, more Qualcomm chips, when at the same time the smartphone market is flattening out? And he actually specifically said, I think you're getting a lot of growth from China, and how long is that going to possibly last? Right? I mean, really tough questions, and I think that's what's creating the overhang in the stock. With his questions, fantastic. Again, we would never care about Taliani's stock price recommendation or target price or whatever else. Nobody would, and he knows that. He admitted that. He said, but his industry analysis and the questions that he asks are dead on accurate to what you want to hear.
And to your point, right, what he's zeroing in on is, like, he's actually basically saying, hey, the Apple story is known out there, but you guys are still posting growth because of China. I think that China is going to run out. And if you look at what embedded expectations are, which is that idea that we talked about for Qualcomm, if we step back and we look at Qualcomm, we look through how performance has been, what analysts forecast it's going to be, and then what the market's pricing in. Right, Qualcomm had a couple good years from 2020 to 2022, where ROA, return on assets, how we look at the total profitability of a business, shot up like a rocket ship. And 23 and 24, things have kind of stagnated. Well, Wall Street analysts, like Tal, right, are basically saying, hey, you're going to have some improvement from those low levels in 25 and 26, but it's not going to be a ton. And the really interesting thing, though, is the market, right, is basically saying, We know Apple's coming though, and we also know what Powell is picking up on, that the China growth could run out. And so the market's already pricing return on assets for Qualcomm to roll over pretty significantly and to drop. And this is where the interesting pivot comes, right, Joel, is because everybody's already talking about this idea of, the concern with China. I think you had a really good, soundbite from the actual earnings call in terms of how Qualcomm management probably even knows about the concern in China, right?
Yeah, I mean, so Taliani said, can you give me a bit of a China update? And then they proceeded to answer questions and did not answer his question. And then he asked again. This is, by the way, this is the last part. If you can, go on YouTube, whatever. So it's the last part of the earnings call, this hour and a half or whatever else. In the last 5 minutes, he's hitting these hard-hitting questions like, the market of smartphones is flat. You're still growing. How long before you flatten? That's basically what he's asking. And he said, because it seems like you're getting a lot of growth from China. Now, I don't know if anyone knows, but China is in massive deflation, and that's not because of currency mismanagement. They're in massive deflation because supply is outpacing demand, and not just in China, but they're also having a supply issue in terms of overproduction to who China is selling to. Right, and these are Chinese smartphones that are being sold, and even that is experiencing export price deflation. And so he's basically saying, look, at some point, the producers are overproducing. You're selling to the producers. What happens when those producers say, okay, we're going to pull back? Will that not hit you? Now, what Robin, I think, is that's already priced in. That this is already being priced in, that the market is not seeing 15, 20% growth that management's communicating. But, oh, by the way, Rob, they then did not answer, and a third time, 3 separate times, Taliani had to say, hey, what about China? And then he said, what about China? And then he asked again, what about China? And finally, the management at Qualcomm said, well, but we also expect there's going to be some subsidies. I was like, so at the very last part of the call, when he's like avoiding the question on China, he still said, but we're hoping that China will subsidize production, meaning
smartphones and everything else.
We'll pay for smartphones to be made that people aren't buying, so that they'll still keep buying more Snapdragons and more Qualcomm chips. So that is an overhang, but we think that's priced in, and that's, Rob, what your point is.
And so it's interesting, everybody, is that's what's priced in, right? When we look at these white bars, the white bars are what the market expects, and the market's already expecting returns to fall off because of the quote-unquote equivalent of a patent cliff, if you will, of losing Apple, of a big drop in revenue like a biotech would get, that we're going to see a similar thing that the market's already pricing in here. But what we think the market might be missing, and this might be a catalyst sometime down the road, is when you talk to really smart people in the AI space, like Professor John Sfiocco, who's a friend of Altimetry and owns his own AI consulting firm, deep thinker in terms of the world of generative AI and everything else. What he'll tell you is, in the next few years, inference using ChatGPT or anything else to engage as a consumer is going to happen on the phone. And that's going to mean a lot more demand for complex chips that Qualcomm makes that end up on the phone. And so when we look at that, we look and we say, you know what, this is clearly something that the market is already negative on the name. That doesn't mean you should buy it now if AI could pick up in the future, but it means at some point Qualcomm is going to pick up. By the way, not dissimilar to how Qualcomm was a straight rocket ship in 1998, 1999, and 2000 in the final part of the dot-com boom. And so, as always, we started talking about the dot-com boom and how it sounds like today, and we're wrapping up with one of the dot-com boom darlings that in a few years could be an AI boom darlings too. And with that, everybody, thanks for joining us for the Altimetry Authority. We appreciate you guys.
Thank you all.
All right, thanks everybody for tuning in. If you want to hear more and follow us on a daily basis, just click the first link below and be able to track what we're doing every single day.